Okay, it's time for real estate question and answer. And the question I got for today is, how well should I know the market before I invest? So, a couple things. My recommendation is always invest in your own market. That would be choice number one. Do I invest outside of my market? No. Would I? Sure. And it depends on what kind of investing that you're doing. Obviously, if you're going to be a passive investor, that means an investor that's buying real estate or investing in real estate that's not going to be doing the day-to-day, then, it being directly there is not as big of a deal. So let me talk to you active investors or investors that want to be active. How well should you know the market? First off, let's assume that you're going to do the market within an hour and a half drive of where you're at. And let's assume you're going to be active. Then that's the beauty of real estate, is the real estate market tells you real fast. You don't have to do like an in-depth study. There's a ton of people out there that are way smarter than me that just get analysis to paralysis, so they don't do anything. In fact, I would say that was the number one dilemma for what's holding people back from investing in real estate or just investing in general, is they want to hit the easy button and just do what everybody else is doing. Well, I don't know if you've seen the national studies, but if you do what everybody else is doing, you're going to have what everybody else has, right? I think I saw a study today. It was crazy. 1%? I know it's like the top 10% of American population have over 50% of the assets in this country. That's a whole nother subject. So what I'm saying is, if you want to be middle class, then do what everybody else is doing. It'll work. Go read Rich Dad, Poor Dad. It explains it right there. Like, don't listen to broke people. And people put up a big facade of, rich or whatever. Bottom line is, folks, real estate's the only way to go. So that's all I can speak to, but I know it works because I live it. So don't do what other people do. The real estate market will tell you whether or not this is working. Let's say, for example, you're doing a flip, right? And you put it on there. Let's say you're doing a buy and hold. All right, so you're going to buy a place and rent it out. So you buy it. You're like, all right, Dave, I'm going to rent this sucker out for $2,000 a month. Listen, the market's going to tell you real fast, unless it's like a blizzard snowstorm. If you're not getting hits, if you're not getting showings, if you're not getting leases signed in the first 10 days in this market, you're overpriced. Change. You got to come down. Now, what I would tell you is it's better to go high than go low, because let's say you listed that same property for $1,200 and it's gone within 6 hours. Yay, happy day. If you're comfortable with $1,200 and the number works for $1,200, then happy yay. But there's got to be some part of you that's like, man, I wonder if I could have gotten $1,500. Like, I'll give you a real life example. I have a third party management that handles a property that I have here in Charlotte. And I think we were renting it for like $1,450. 3-bedroom, 2-bath, Charlotte, North Carolina. So the property manager had the tenants been in there 2 years. And the tenant, I came back and I said, I want $1,800 for the property. Well, that's going up $350. Granted, that's a big jump for a year. And the realtor came back to me, right, the expert in this subject. Sorry if you're watching, but just facts are facts. The expert on the subject came back and said, hey, Dave, it's been a good tenant. I ran the numbers, I ran the comps. I think we can get him to stick at $1,600. And if I was a normal investor who didn't have a gazillion other properties and hadn't been through this a million times, I would be like, okay, well, you're the expert, so $1,600 it is. And you're celebrating, right? $150 more, go straight to the bottom line, net cash flow. And I said, well, Bob, that sounds good, and I can appreciate that. Let's go back to him with $1,800. Am I being a jerk? Am I being unreasonable? No, be a little unreasonable. Guess what he did? Signed it. No questions asked. And so now I'm almost wondering, $1,800, I'm not talking to be greedy, but listen, it is not your job as the investor to look out for somebody else's welfare. Other than, or I should say, not their welfare, but it's not your job to keep food on their table, right? Should they have a safe place, a place that's well maintained? Don't be a slumlord, not fixing anything. This is a nice neighborhood. So he's happy, I'm happy. So don't, just so you don't shortchange the skills that you have in life, you got to know the market. Now, in this particular case, had I not known the market, I would have cost myself $200 a month, $2,400 a year. And it's not just, oh wow, Dave, $200. That's $200 bottom line profit. That goes straight to the bottom line. Now you take out the management fee, whatever. It's a small portion of it. But, so that's a real world example of where knowing the market can make or break you. Now, let's say there wasn't somebody in that property and we listed it for $1,800. Again, 10 days, not even 2 weeks. You're you're not getting calls. Nobody's going to see it. You're not getting inquiries. Make some changes. Better to go too high and back down. And I would say the same thing on sales. If it's better to go too high and have it sit there for 10 days. 10 days is not going to make your property, look like it's stagnant. But it will tell you real quickly. And I honestly think real estate's one of the best models for that, because you don't have to wait 2 months to see, what the market's going to bear. They'll tell you real quick. So now, do you need to know all the ins and outs? Do you need to know, there's all kinds of studies. If you were some kind of hedge fund buying properties in Charlotte, North Carolina, you'd say, okay, well, there's this projected growth. There are some indicators. So here are the websites I use just to give me an idea. Zillow. Same thing you can pull up. Nothing high price, nothing elaborate. Pull up Zillow. They'll have on there what's a Zestimate in terms of the value, and then what's the Zestimate rental. And I would say, in my experience, they may be a little on the high side in terms of their estimates. But if they don't have a Zestimate, here's a little trick of the trade, rule of thumb. If, let's say, that your property, Zillow has it listed at, value at $200,000. You should be getting $2,000 a month. The 1% rule is an easy rule to remember. And what you do, it doesn't always apply, because if you got a $500,000 house, you may not be able to rent it for $5,000 a month. But on the lower end type stuff, it's pretty, pretty accurate. $200,000 house, $2,000 a month, very reasonable. Because what that tells you is you should be getting 10% return on your money. So that's not quite 10% when you factor everything else in. It's because you've got expenses, you've got taxes, insurance, mortgage, all of that. It's not going to be bottom line 10%. But, as anybody that's got questions, pipe up and just say, hey, what about my market? That type thing. So generally speaking, in America right now, if you're having a hard time renting, that would be unusual. I know my market, And here's the other thing too. I was watching something with Grant Cardone the other day, and I think he's right. Right now, we have a 45% renter base in America. Means out of 100 people in this country, you got 65 homeowners, 45 renters. So over the next couple of years, with rising interest rates, with banks either going under or tightening up on their lending, requiring more down, less stuff. You know, when they raise interest rates the way they have, it's going to slow construction down, which means there's going to be less houses on the market. There's going to be less people that are willing to give up that 3% rate they lock down and move and buy other properties. So what does somebody do that's moving to Charlotte or Kansas City or LA or, you know, Seattle when there's nobody selling? Because they don't want to lose that. There's going to be a demand. That's why I think it's going to be different than, you know, the foreclosures that we saw in 2008, which, by the way, I was in real estate in 2008 on both ends as an investor and a banker. So I rode through that. I saw it firsthand. I don't think we're going to experience the same stuff. But if we convert, like if you had a crystal ball right now and you said, oh man, Dave told me in 2023 that in the next couple years, I don't know, 5 years, let's say, it was going to switch and 20% increase in renters, which is actually more than 20%. It'd be more like 35% increase in renters. If you had that crystal ball and you knew it was going to happen, what would you say is going to happen? Rents are going to go up or rents are going to come down? Rents are going to go up. Supply and demand, right? So what that's going to do is not only raise rents, but it's going to raise the quality of renters. So as landlords, that hold on to these properties, we can do better screening, get better tenants, and raise the rents to market rents, which is going to continually rise. Over the last 50 years, rents have risen 5.1% through all markets. 5.1%. That's higher than inflation. And I'm talking appreciation. That's just icing on the cake. I'm talking the actual rents. And if you think about it, if you're renting right now and your rent's $1,000 a month, on average, you're probably seeing the next time it comes around, you're at $1,050. And the next time you're at $1,100. Now, here's the question I need you to ask yourself. If you're a renter, if you've ever rented, let me see your beard. Yeah, got a little gray in there. Yeah, if you want to call that a beard, I'd make an awful Viking. That's what I call my COVID scrub, really. I hadn't really cut it much. I trimmed it, but I haven't really taken it down since COVID. But if you've ever rented before, have you ever had your rent come back? And you know what? You get that letter in the mail. XYZ Management Company, listen, Joe, you've been such a good tenant. We just feel obligated to lower your rent. Never happened. I wonder why that is. Ever. Through, doesn't matter who's in office. Doesn't matter what the economy's doing. Unemployment. Blah, blah, blah. I'm not saying it's not affected by these things. I'm not saying there's one-off markets. I'm just thinking, guys, real estate's a long-term investment. It's not, grab and go. So you got to look at long-term data. And the data says rents are going to go up 5.1% every year. That's $50 a month on a $1,000 rent. That's $50 a month that goes straight to the bottom line. Now, if you've locked in a mortgage at 3% and you're thinking about selling that house as opposed to keeping it as a rental, you can make a strong case for keeping it as a rental. That's how I got started. I kept my primary house, a little 3-bedroom, 2.5 bath, rented that bad boy out, kept my good rate. Now, granted, this was 18 years ago, so my good rate was probably 8.75. But I was able to cash flow, which is really just the name of the game. So, know the market. use Zillow. I'm gonna give you a couple of other tricks, so stay tuned here. Rentometer. Just Google rentometer.com. I think they give you like a 7-day trial. I use it. Is it the Bible? No. But it's going to give you an idea of, hey, like here's what I found. Even being in the game, even owning the properties that I own, even knowing the market, I would get in there and I'd be like my leasing manager would call me up and she'd be like, we're getting $1,200 for that 2-bedroom. I'm like, get out of here. There's no way somebody's going to pay $1,200 for that 2-bedroom. Then I go on Rentometer. I'm like, holy smokes, it's $1,250. We're actually giving them a discount. So I'm not saying I'm the best of the best. I'm not claiming that. But if anybody should know the market, it should be me. And when I miss it, how do you think mom and pop, who owns 1 or 2 rentals, is not going to miss it? So use these tools to kind of keep you in the game. And, you know, like I said, that Rentometer's free. I think they give you a 7-day trial. So if you just did it once a year, but like I pay for it. It's not that much, $13 a month or something. Just depends on if you're going to be in the game. And again, it's not the Bible, but it gives me a gauge, and they've done all the research. So really the most important research is going to be putting it on the market at maybe just a tad higher than what you think you can get and seeing how long it sits. Don't sit on it for more than like 10 days. I don't know why that number comes to mind, 10 days. I'm just arbitrarily making that up. But it seems reasonable that if your phone's not ringing after 10 days in this market, it's not like we've got a, 40% unemployment or something crazy. So know the market. So use Zillow, use Rentometer. What else can you do to know your market? You know the good and bad areas. I'm not a real estate agent, so I can tell you how it is. There's bad areas. There's crime. I think I don't use it. There's a program that we do use on Yardi that will tell you like the crime areas. Obviously, obviously you want to stay away from crime. Another interesting fact, if you're looking at a house that's across the street from like a school, generally, believe it or not, they're safer. You know why? I didn't know this. Because if you're selling drugs within, I don't even know what it is, 500 meters of a school, or there's some kind of rule, they hammer you. They throw the book at you when it comes to sentencing. So I've never sold drugs, so I wouldn't know. But apparently that's something known, and so they try to stay away from that area. So anytime I see a house that's across from a school, I'm like, okay, I'll pay a little bit more for that because I don't have to worry as much. It's just an indicator. Man, there could be a drug dealer right next door. There's no telling. But just know, you can't ask your realtor because they're not going to tell you. Like they're legally bound, they can't tell you. But you can pull up the school system, see how many stars, how they're ranked. That's going to be an indicator. It depends on what your target audience is too. Like if you're trying to rent a low-income house, houses are classified, and mainly apartments are classified in a couple different categories. A, that would be your like most sought after, best school system, close to things that are happening, very desirable area. B is kind of like middle class, desirable area. C, you're starting to get a little, you're definitely in the shady areas. And then D, you're just like, you're straight up like, bad. So embrace what it is. I have a lot of properties in C and D neighborhoods. I'm okay with that. But I'm not trying to rent those suckers out for $2,000 a month and call it. And I'm also not, this is another key point, don't fix it up like it's an A neighborhood. Let's just say, and I've done this before, I come in, it's 2,500 square foot, beautiful old Victorian 1920s home on 23rd Street. Go back and watch some of the TikToks. I made it beautiful, you know, laminate flooring, painted, put in an HVAC system, but know your market. Like I knew when I put that HVAC system in, HVAC, that's an air conditioning system, I was going to have to put a steel cage around it. That's crazy, right? What's an $8,000 HVAC unit? It will get stolen. Know your market. Would you have to do that in an A neighborhood? Probably not, you know. I'm not putting granite countertops in that house. I'm not putting, you know, I did put a dishwasher in there. Yeah, I think just because I bought it as a package. No, I didn't. I put a microwave in there. Man, I don't put microwaves in my properties that are in B or C and D, neighborhoods. A and B, you have to. Dishwashers, microwaves, the whole thing. But I'm also not charging the same. So it's just like, listen, you know the difference. Nothing against these places. But you know the difference if you're staying at a Motel 6 and a Ritz-Carlton. I'm just calling it like it is, right? And if you don't, if you expect Ritz-Carlton amenities at Motel 6 prices, and let's put it, you know, and think about it, this is another way to kind of think about it. I think I've beat this point to a pulp here, but Ritz-Carlton ain't going to a D neighborhood. So neither should you. You don't build the amenities that have A amenities in a D neighborhood. So again, know your market. The way you know your market is look at those renometers. Drive around the neighborhood. Pull up the crime. Pull up the school systems. If you're from the market, like if it's your hometown, you're going to know. So now, do you have to do, again, I say all this, don't get stuck in analysis paralysis. Don't get stuck as, well, I need a spreadsheet that shows exactly what I'm going to spend on a microwave and how much I'm going to get my money out on it. You'll, by the time you run all those numbers, the house has already been sold twice. So what I would say is educate yourself to a certain extent and get to know the market and then pull the trigger. More important than know the market is knowing your cash flow. So you know the market, you know what kind of area it's at. Now you know what kind of payment you can receive, then you back into it. So if you know your payment's going to be $1,000 a month, you're not going and buying it for $100,000. You got to be buying that sucker all in with rehab and everything at around $75,000, $80,000. If you're going to be able to charge $1,000 a month, because you got to have some equity going into it. Now, would it make sense if you could be all in at 95? Yeah, you could probably justify that, especially your first one, because the market's tight, you know. But I see people going in at 150 and charging $1,000. They just didn't know the market. They overpaid. So, listen, does it happen all day long? Is it going to be me? No. I hope not. You don't ever want to overspend because it's too hard to dig your way out. Cash flow, cash flow, cash flow. So, hope that's helpful. Check out kingsfundinvesting.com for more content. I also have a YouTube page that I post these things on. Kings Fund, that's Kings, King like Jesus, Lord and Savior. On YouTube, Kings Fund. I don't think it's investing. So go check that out. Bunch of videos on there. I get in there, I show you what I'm doing in these houses. And I mean, I could sit here and talk till I'm blue in the face, but I think it does help to go in there and see some of these like before and after things, videos that I've done, and say, okay, Dave, maybe I should do that in the future. Be like, this is a C-class neighborhood, and here's why I'm doing what I'm doing, you know. But you'll see, hey, he's not putting in granite countertops, or he is putting in granite countertops. Here, he's putting in a dishwasher. He's not putting in a dishwasher. Why is that? Because I know at the end of the day, there's certain amenities that it's very, very possible, and where you get yourself in a lot of trouble is overspending, over improving the neighborhood. So hopefully that helps. I'm going to cross the road here and try not to get hit. And as you have questions, that's where these come from. So hit me up with questions, anything that you need answered in terms of real estate investing, and then just be on the lookout for the next one. And we'll keep you posted. Thanks for tuning in.